Silver just bounced from $79 to $86 in 24 hours. After crashing 11% in 80 minutes, after losing $1 trillion across precious metals, silver is clawing its way back. And this isn't just a technical bounce. This is what happens when the market realizes that wars don't end inflation, they create it. That energy disruption doesn't kill demand for silver, it multiplies it. And that paper price manipulation works until physical reality forces the reset. Hi, I'm Roxanne. We don't sell courses, we don't sell signals, just real data on what's actually happening and why it matters. Let's break it down. Before we dig into why silver is rebounding and what history tells us happens next, here's where we stand right now. Silver trading at $86 as of Wednesday, March 4th. That's up roughly 9% from the $79 low we hit Tuesday morning. Gold holding above $5,400, up 19% year-to-date after a 64% rally in 2025. MCX silver in India has gained over 16% year-to-date. The rebound isn't happening in isolation. It's happening while the Middle East conflict escalates, while energy prices surge 70% in 2 days, and while every economic textbook on war and inflation is being rewritten in real time. Let's start with what actually happened in the last 24 hours, because the mechanics matter. Silver hit $79 Tuesday morning after that 11% crash. Within hours, buying started coming back. Not from retail panic buyers, from the people who understand that an 11% drop during a war that's shutting down 30% of global oil supply isn't a new trend. It's a gift. By Wednesday morning, silver had climbed back to $86. That's a 9% recovery. Technical analysts are watching the 50-day exponential moving average at $87 and the 100-day EMA near $86 as resistance levels. The RSI rebounded from oversold territory near 30 back to 45, showing momentum reset but not yet full bullish confirmation. FX Leaders notes that $83 is the line in the sand for bulls right now. Holding above that level keeps the short-term recovery intact. A move through $87 could open the path toward $90 to $92. And here's what matters. JP Morgan maintains a 2026 average forecast of $81 per ounce, noting that the current geopolitical climate could easily push prices toward $100 by mid-year. But some analysts are going much further. Bank of America raised its 2026 silver forecast to $65, with potential spikes to higher levels. And extreme compression scenarios, where the gold-to-silver ratio collapses from the current 63 to 1 back toward historical norms of 30 to 40 to 1, put silver targets at $135 to $309. That sounds insane until you realize the mining ratio is 1.7 to 1, and the COMEX vault ratio is 1.11 to 1. The paper market is pricing silver at 63 ounces per ounce of gold, while the physical world is telling you it takes 1.7 ounces to mine them together. Now let's talk about why this rebound matters and what history actually tells us about wars, inflation, and precious metals. Because if you understand the pattern, you'll understand why $86 might just be the beginning. Wars don't just create uncertainty. They create a specific economic sequence that plays out with remarkable consistency across centuries. Government spending explodes. Money supply expands to finance that spending. Inflation follows. And when inflation arrives, people run to assets that hold value when paper currency loses it. During World War I and World War II, gold prices spiked significantly as investors sought refuge from the uncertainties of conflict. The American Civil War saw massive fluctuations in silver due to economic instability and monetary policy changes. The Coinage Act of 1873, known as the Crime of 73, demonetized silver in the aftermath and led to a sustained price drop. But during the conflicts themselves, precious metals surged. Here's the pattern. At the start of a war, fear drives an immediate spike in gold and silver as investors panic buy safe haven assets. That's what we saw when the US and Israel struck Iran. Silver gapped to $97, gold punched above $5,400. Then comes the crash. Why? Because the market prices in a growth scare. If oil infrastructure is destroyed and energy prices spike, Factories might shut down, which means less industrial demand for silver. Algorithms see that and dump industrial metals. But here's what the algorithms miss. Wars don't pause economies. They transform them. The shutting of oil supply doesn't mean we stop consuming energy. It means we have to get it from somewhere else immediately. And the only energy source that can be deployed rapidly without relying on a pipeline running through a war zone is solar. And solar panels require silver. Let me give you specific numbers. Silver paste is used in solar panels to collect and transport electricity. It accounts for only 3 to 5% of a solar module's total cost. When silver rises from $50 to $100, the module cost increases by just 1.5 to 2.5%. But without silver, the factory shuts down. So manufacturers will pay $150 per ounce, maybe even $500 in extreme scenarios, because the cost of not buying is a full production line going dark. Industrial fabrication now accounts for nearly 60% of global silver demand. Solar panels, electric vehicles, electronics, AI server infrastructure. These aren't discretionary purchases that disappear during a recession. They're necessities that get prioritized even higher during energy crises. Europe can't wait 5 years for a new nuclear plant. They need power on the grid in 6 months. The only way to get that is solar, and solar needs silver. Here's the part that's confusing investors right now, and it's why silver crashed before rebounding. The initial reaction to war is deflationary fear. Markets worry about growth collapsing. But the sustained reaction to war is always inflationary reality. European natural gas just surged 70% in 2 days. Oil gapped to $82 before being suppressed back to $70. But physical supply pressure is mounting. Iraq shut down Rumaila, the world's second-largest oil field, producing 1.5 million barrels per day. Qatar's LNG production, representing 18 to 20% of global supply, is offline. The port of Fujairah in the UAE, the only significant oil shipping route bypassing the Strait of Hormuz, was hit by explosions. When energy prices spike like this, everything gets more expensive. Transportation costs rise, manufacturing costs rise, food costs rise. That's inflation. And when inflation arrives, central banks face an impossible choice: raise interest rates to fight inflation and crash the economy, or keep rates low and let inflation run. History shows us what happens. During Vietnam, the war spending combined with President Johnson's Great Society programs created massive inflation that didn't fully show up until the 1970s. Gold went from $35 per ounce in the 1960s to $850 by 1980. Silver went from $1.29 to $49 in the same period. The pattern is consistent. Wars create government spending. Government spending creates money printing. Money printing creates inflation. And inflation creates demand for assets with intrinsic value. Not because people are afraid, because their cash is losing purchasing power and they need something that holds value. Right now, we're at the beginning of that cycle. The US dollar rose 2% over the last 2 sessions as money fled back to US Treasuries during the immediate panic. But if this war extends for months or years, if oil stays elevated, if energy costs keep climbing, that dollar strength won't last. It can't. Because the US will have to print money to finance the conflict, and every dollar printed dilutes the value of every existing dollar. Now here's where 2026 diverges from historical patterns in ways that make the setup even more explosive. During World War II, silver's industrial use was limited. During Vietnam, solar panels didn't exist. During the Gulf War, electric vehicles were a niche curiosity. Today, silver's industrial applications have become so embedded in modern technology that the metal has transformed from a monetary asset into a strategic resource. Samsung just locked up exclusive rights to 100% of a Mexican mine's silver output for 2 years through a prepayment deal. That's not speculation. That's a tech giant securing supply because they know physical silver is about to become scarce. The Silver Institute projects a 67 million ounce deficit for 2026. That's the 6th consecutive year of deficits. Above-ground stockpiles are depleting. COMEX registered inventories are down 70% since 2020. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn for delivery in just 7 days. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. And here's the kicker. Silver is mined primarily as a byproduct of other base metals like lead, zinc, and copper. If the recession thesis holds and general mining slows down because demand for those base metals drops, then the supply of silver drops with it. So you get a scenario where demand for silver explodes due to the solar panic and energy transition, while supply contracts due to the economic slowdown. That's the perfect supply squeeze. Safe haven buying is back, and here is how we know. Gold and silver are rebounding after yesterday's declines. Investors are seeking protection amid the escalating US-Israel-Iran conflict and growing uncertainty across global markets. Signals from Washington and Tehran suggest the conflict will not end soon. This has triggered declines in global equity markets. The ongoing shift in investor portfolios toward defensive assets is supporting prices of both gold and silver. At the same time, structural factors like geopolitical uncertainty, unpredictable monetary policy, and the need for portfolio diversification continue to support long-term demand for precious metals. India's MCX shows gold up 19% year-to-date after the 64% rally in 2025. Silver up over 16% year-to-date. Domestic demand in India, one of the world's largest precious metals consumers, is supporting prices. When Indian buyers step in during pullbacks, it puts a floor under the market. China's behavior is even more telling. Shanghai spot silver held a $10 premium through the entire Western dump Tuesday. Chinese buyers didn't blink when Western paper crashed. They kept buying physical at higher prices because they understand something the algorithms don't. Physical silver is finite. Paper contracts are infinite. And when the gap between paper and physical gets wide enough, paper loses. So where does silver go from here? The honest answer is nobody knows with certainty. But we can look at probabilities based on historical patterns and current fundamentals. Short term, silver needs to hold above $83 to keep the recovery intact. A break above $87 opens the path toward $90 to $92. If the war escalates further, if oil stays elevated, if Europe accelerates solar deployment as an emergency measure, then $100 becomes very realistic by mid-year, which is JP Morgan's bull case. Medium term, the supply deficit story hasn't changed. 6 consecutive years of deficits. Industrial demand at record highs near 680 million ounces annually. Mine supply constrained because silver comes mainly as a byproduct. COMEX inventories drained. That structural tightness supports prices regardless of short-term volatility. Long-term, if the gold-to-silver ratio compresses back toward historical norms, the math gets explosive. The ratio is currently 63 to 1 in paper markets. The mining ratio is 1.7 to 1. If paper moves halfway back toward physical reality and hits 40 to 1, and gold is at $5,400, then silver should be at $135. If the ratio compresses to 30 to 1 during a commodities supercycle, silver hits $180. Is that guaranteed? No. Markets don't follow mathematical inevitability. But the probability is high enough that serious analysts with billion-dollar funds are positioning for exactly that scenario. We should be intellectually honest about the risks, because nobody benefits from one-sided analysis. Silver could pull back from $86 if the dollar continues strengthening. If the Federal Reserve signals they won't cut rates due to inflation fears, that could pressure metals in the short term. If the war de-escalates quickly and oil supply normalizes, the immediate crisis premium could evaporate. Western mining stocks haven't followed Chinese miners higher yet. That divergence could be a warning that institutional money in Western markets isn't fully convinced. Short covering has been driving part of this rebound, not fresh money entering. Once covering exhausts, you need new buyers to sustain the move. Technical resistance at $87 and $92 are real. If silver can't break through those levels, it could consolidate sideways for weeks, or even pull back to test $83 again. And if you're using any kind of leverage, these aren't small details. They're the difference between surviving the volatility and getting liquidated on a temporary dip. So here's the story. Silver crashed to $79 Tuesday, rebounded to $86 Wednesday. That's a 9% recovery in 24 hours. JP Morgan forecasts $81 average for 2026, with potential spikes to $100. Bank of America sees $65 with upside scenarios much higher. The gold to silver ratio sits at 63 to 1 in paper, while mining ratio is 1.7 to 1. History tells us wars create inflation creates demand for hard assets, and silver benefits from both its monetary role and its industrial necessity. The Middle East conflict is escalating, not resolving. Energy prices surging 70% in 2 days. Europe will need emergency solar deployment. Solar needs silver. Industrial demand at 680 million ounces annually. Supply deficit for the 6th straight year. COMEX inventories down 70% since 2020. The paper price crashed to $79. The Shanghai premium held at $10 above Western spot through the entire dump. Physical buyers didn't panic. They bought the dip. Samsung locked up exclusive mine output. Tech giants are securing supply because they see what's coming. This isn't a prediction. It's a probability based on patterns that have repeated for centuries. Wars transform economies. Energy crises accelerate transitions. And silver sits at the intersection of monetary demand and industrial necessity. The rebound to $86 might just be the beginning. Verify everything, stay informed, and I'll see you in the next one.